Hi guys, welcome to this episode. Hi Cam, hi Joseph. It's a pleasure to have you guys here. How are you today?
Thank you for having us.
Yeah, all doing well. Thank you, Nikita. Pleasure to
Great,
be here.
thank you. Thank you very much for being here. So I would like to start directly with an introduction from yourself, guys. Give us your background. Who are you, and most of all, what are you trying to do with Defiant VC?
Sure. I can maybe jump in, Cam, and feel free to go after. We'll try and keep it short. I think intros can always drag on. But a little bit about me. I'm actually an engineer by background. So that's I always started off as a young kid doing the cliche thing of pulling things apart at home and sticking them back together and TV remotes and fans and things that pissed my dad off a little bit. But I went into sort of engineering and I always had this like really mathematical mindset. Uh, I kind of pivoted after doing that for a little bit of a time in Australia into finance. I'd always been like really passionate about finance and then kind of have had a decade-long career now in financial markets, investing, mainly in venture and early stage. So I used to work at two pretty well-known funds in Europe. One was called Vitruvian Partners. Another one was called Felix Capital. I was about a 10-year career spanning over that period, and I've been very lucky to invest in a lot of companies that became, global, global successes. So I've had the opportunity to work with 9 unicorns over these 10 years,
Wow.
deployed about $400 million of capital, companies that hopefully some of your listeners would be familiar with, like TransferWise, or as they've rebranded to Wise now. Marqeta is another company I invested in and saw them listed in New York. Companies like Ledger.
I love Market. I've been talking with them multiple times in the past for different
Yeah,
projects, and I really love what they do.
it's an excellent business, and they were just, the founders are exceptional, and then they were
Yeah.
just right place, right time as well. They came to market with a proposition that just needed to exist, and they've scaled exceptionally well. Other companies I invested in, things like Travelperks, which is an expense management for travel. Pigment, which is a French unicorn doing FP&A, back office, fintech stack. There's Forta, an e-commerce fraud company. So there's been a long list. Fintech is an area that I've always been really passionate about. I think it's a great space to invest in, particularly now. Actually, I think the market is really attractive.
Yeah.
So yeah, that's a very quick summation of just, I guess, my background.
Yeah, so look, I come at this from a bit of a different angle. So I was a trader for the first half of my career. I started in derivatives and then had multiple algorithmic trading roles, companies like Virtue and Macquarie in Sydney and in London. And then I had a risk profiling startup. So this idea of trying to marry psychology and investing together to recommend people better investments. And I was the solo founder there and the main developer there. So kind of learnt to code in that process. And I ended up exiting that and then joining a larger product org, and I was with them as they scaled from 1 to 10 million in ARR. So I had a really nice like solo founder story, and then moved into a very good scaling business for some years. So when JP was thinking about Defiant and thinking about meshing venture and with a focus on products and data, I was an obvious choice with a more quantitative finance background and then more recent B2B SaaS product building background. So yeah, that's me in a nutshell.
Yeah, let's say it's not easy to transition from derivatives to actually coding. So
Yeah,
it was a challenge. I
it was
presume.
necessity more than anything else.
Yeah,
I
I
had
can
something I wanted to
understand.
build and hit my head against the wall for a few years doing it, and you learn
Yeah,
in the process. So yeah,
yeah,
yeah.
absolutely. So tell me about the fund. So how did the idea came out? You saw a specific spot in the market, something that you wanted to do, or it was out of opportunities mostly?
Yeah, it's been, I guess, a while in the making. Like I've been investing, for about a decade, and I think like there's that old saying, only the kind survive in our industry a little bit. And I
Yeah.
think like I've always been the sort of person who's always like, what's the future? Where's this industry going? What does venture look like in 10 years time? And it was just kind of this realization or belief that the future is going to look quite different in terms of venture capital, and it's going to be a lot more sophisticated in terms of the asset class, the use of technology, the use of data, all these sorts of things. And if you kind of just take a step back and think about like venture as an industry, it's been around since the 70s. So,
Yeah.
Silicon Valley, Saville Rhodes, those, the Kleiner Perkins and Andreessens and those guys were founded in the 70s. European venture is obviously a lot younger. It's only been around for probably about 20 years, maybe 30 if you're lucky. But the product that is venture really hasn't changed in those 50 years. Like the vast majority of funds, there's thousands of funds out there, but the vast majority of them are doing exactly the same thing today as they did 50 years ago. It's very manual. It's often very one-to-one and unscalable in their workflows.
Yeah.
And they're just not really kind of keeping up with the pace of innovation that other industries are seeing. And, it's like slight parallels. We're not trying to build a quant fund, but if you look at what happened in the world of hedge funds, they used to be rooms full of analysts, and now they're all rooms full of computers, right? They've gone from completely, human to I guess, tech-based. And even just like the software that we fundamentally invest in, a lot of investors, we do software, fintech, they've evolved, the stacks have evolved. We've gone on-prem, mobile, AI, there's just been so much innovation, and venture's really resistant to change. So I guess kind of like where I'm coming to is, it was just a realization that, and a core belief that venture is going to become a lot more data-driven, a lot more product-centric, a lot more sophisticated. And at the same time, you have this kind of like irony that we invest in technology, we advise, technology founders, we build boards, and very few funds have any idea how to build products, any idea what is involved in scaling a business or scaling a product or go to market. So we felt like there was a spot in the market to be something that looks actually a lot more like a software business, a fintech business versus a traditional venture fund. So yeah, it's kind of
that's very interesting, because I think that this kind of discussion has been going on in the market for a lot of time. There's a lot of people saying, okay, the venture model, as we usually saw it, is not working anymore because you have too much risk and basically too much space for failure, basically. And we're doing the same things that we were doing, 30, 40 years ago. So there were basically multiple type of experiments in the last 5-6 years, launching different kind of models from, startup studios, venture studios, corporate venture capital, many different kind of models. And I think, to be honest, not sure, of course, but gut feeling here is that none of them actually worked out how they wanted it to be. So there are a couple of good experiments in Europe and in the US that are working, but a new real working model is still to be found, in my opinion. And I love the comparison with the hedge fund world, to be honest. You saw, that kind of shift in the hedge fund world that really worked out in the end. So there's no hedge fund that is not doing quant at the moment. That's actually not happening, and you do believe that it's something like that could happen in the venture capital world? And how could, a new model be shaped in that direction?
I think one thing with venture is that it's always a person business. It's like a people to people, relationship building. So
it's a network business, basically.
It's a network business, but it's also like the relationships are core to everything. Like when you invest in a founder, it's a decade-long experience. You want to, you need trust on both sides of that relationship. You need to like each other. And so I think the whole pure quant strategy won't work in venture because you're missing that core part of the business. But what we really think the future is this kind of like human in the loop, human empowered by technology sort of business model, where it's a small investors, typically more senior in their profiles, who have these tools in their toolbox to be faster, better, smarter, more efficient with their time. They can share actual real data-driven insights with founders. We can deliver productized value to our founders so that it's reliable, it's scalable. It's really this kind of concept of taking a really great investor and then making them 10x better through technology. That's what we think is the future. But Cam, you please jump in as well.
Yeah. So I think you're hitting the nail on the head, Mikhail, in terms of these other a quant-based model we don't believe will work, and that's not our product strategy in terms of where we're focusing. And I think what is genuinely very differentiated. So I think there's a certain amount of VC who have the data-driven strategy, which we believe in, and often they're a little bit earlier stage than we are. So they're probably pre-seed, seed, and they're using data-driven to act as a sourcing funnel or to source investments. And we're focusing less on that area. We think that's quite commoditized, and also given we're late seed Series A, it's kind of a little bit less relevant, funnel's smaller. But where we're really different is us building products which focus on giving value back to founders. So it's that later stage in the value cycle, and our ability to give genuine value, because we believe that there's a lot of promises made in venture and not necessarily follow up. And the more we're able to productize some of the value that an investor gives, which of course isn't a lot of value the investor gives, which you can't productize, but we think a certain amount of it you can. And by us building products to give value to founders, it means that we can show value to them up front, and we can show value to them before we invest in them. And we think that's a really effective tool to kind of flip the paradigm and be able to, for founders, deliver genuine value. But for us, it obviously acts in a lot of different positive ways in terms of our broader business, and our ability to have a presence in the market and to gain friends early, basically, with founders that we wouldn't necessarily have.
So basically, it's just to let me know if I'm wrong here, but it's trying to bring the product thinking way of thinking into the venture capital, basically.
Yep, sure. Yep.
Okay. Yeah. No, that's absolutely interesting. And at the same time, there are a lot of VC that claim to bring value to the founders. And that was an argument for a lot of time. And then let's say in the back end, that's not always the case. So how do you actually plan to actually bring that value to those founders?
Do you want to take a Cam, or do you want me to?
Yeah, I can start. So we have a long roadmap, and obviously a certain amount is conceptual, and we'll validate through time. But I can tell you a little bit about the first couple of products that we've built. So the key one to begin with is our blueprint product, and it's this idea that a lot of founders don't necessarily know at a point in time what they need to do to raise capital in the current market. VCs often will be looking for different things, different market environments. It might be efficiency or growth or whatever else. And metric benchmarks change. So the amount of revenue you need to raise, the gross margins you need to raise are transient through time. So from speaking to lots of founders and them making it clear to us that they were often uncertain about how they were placed, and a very common task for us would be to try and give feedback to a founder. We jump into our reams of spreadsheets and jump into our SharePoints and Google Drive to try and get comps up. We realize that there's a lot of efficiency to be gained by just having all that information structured and standardized in a database, which seems like a very obvious thing to do, but most VCs don't do it. But then having this as a self-service product, so the ability for a founder to go in, run through a highly interactive, effectively onboarding experience of their data, and then immediately, without any interaction with us, getting a benchmarking blueprint report. This idea that they can understand how their business is doing versus comps, which are relevant to them, and then how well they're placed to raise in the current market environment. So look, I think that's a really good example of where the data-driven strategy comes together with a real burning founder need, or like a really common question, and something that's very time-consuming as an investor to do, to actually go through and find the right comps and everything else, and give that back to the founder, and something we've been able to productize quite effectively.
Oh, that's pretty clear. So you guys just raised a fund to do that. One of the let's say the obvious question that I had in mind was how it was to actually raise a fund in this kind of environment. We're coming out of 2 very tough years, at least in the fintech market, but overall in the VC industry. So raising funds right now is not the same as raising it in 2015 or 2016. So how hard it was, and how was the process overall? How was your experience about it?
I think there's no way to cut it. It's been incredibly challenging. The market is, if you just look at the data, it's the worst it's been in a decade in terms of raising first-time funds. So, PitchBook produces a quarterly report, and the forecast for, I think, 2024 was, less than 100 new first-time funds versus at the peak, it was over 400, 500, so just like the numbers show that it's the most challenging it's been in a very, very long time, but actually in my whole career. So, the timing is everything, and we probably chose the hardest, the worst time to try and do this.
It was too easy otherwise, you should have had a bit of challenge.
Yeah. Well, challenges make you get better, right? So like, adapt to the market environment. I think it's, despite all of that, we've been very lucky, I guess, in our fundraising process. We've only really been in the market for about 6 months officially, which is, most funds are taking north of 2 years, 2 to 3 years to raise their first funds. So we're on a good trajectory, but we still obviously have a long way to go. We announced our funds, this was 2 weeks ago, where sort of, I've raised about 30 million. Our target is 70. So we're still going to be fundraising for a bit longer, hopefully get us closer to that figure. I think the keys in this market, though, the key thing you need is differentiation. You need a strategy that's interesting. You need a track record. You need an experience. And we have kind of been quite fortunate to tick a lot of those boxes. Our LP discussions, the feedback we get is we're incredibly different to everything else in the market. When people see our products, see our brand, see our strategy, we've really been put into a separate little box as opposed to everybody else, which is very nice. And I think that has led to a bit more success. And then we have, we're an experienced team. We have a suite of advisors who help us, who add a lot of value. We have a very clear strategy. So I think we've kind of ticked as many boxes as we can, but at the same time, it's just, the market backdrop is what it is. It's really tough.
Yeah, I think that the market is one of the main question mark there, so we're coming out of, let's say, at least 4 or 5 years of free money, at least until 2020. And it was very, very easy to raise funds in that period. But right now, there's a lot of competition. Interest rates are high. There's a lot of people in the market actually trying to do that at the same time. And it's not that easy. And I think that you said something that, in my opinion, resonates a lot. Also in the last couple of conversations that I had, because I think that you need to differentiate yourself in a way, in a new, unique way. And at the same time, you need to be relevant in the market. So you need to be that point of reference, at least for your segment or at least for your vertical. Otherwise, no one is just coming back to you to give you free money. And that is very, very relevant. So you said a lot about your investment strategy, and I think it makes a lot of sense. You focus mostly on early stage, let's say pre-seed seed.
Seed and Series A is what we do. So early stage, but slightly out. We kind of look for companies that are finding or have some early stages of product market fit. That's kind of how we define it. So we don't do pre-revenue, pre-product just because we need data. Like our whole strategy is quite synergistic. We want to see some signs of traction, and we want to benchmark. We want to give insights and share, best practices. So we don't do that early. We're very much like, we've got kind of, rough benchmark is 200K of ARR up to probably 4 or 5 million. That's really like where we think we can come in.
That's very interesting, because in that range, there are a lot of startups at the moment. So compared to, like, for example, 4 or 5 years ago, I think that the 100K or 200K in terms of ARR is a level that is more achievable right now. There are a lot of companies that are trying to raise money at that level at the moment.
Yeah. I think the market's shifted, what you call a seed, a pre-seed, a Series A, like it's always fluid, right? And I think it's that's why we don't really try and use the terminology. We just kind of focus on what is the actual business doing and where they are in terms of maturity. So we'll do a bit of seed, we'll do a bit of Series A, but it's really like these companies that are just starting to find product market fit. And the reason we picked that segment is it's where we genuinely believe we can add value as well. It's like I think that's the inflection point where a founder needs somebody who's experienced, who can help guide you, who can give you data, insights, roadmaps, where our value becomes the highest. Is that really that little spot there?
In terms of geography and industry, what's your main focus there? So Europe, US, you act widely, globally?
Yeah, so we're a B2B SaaS and Fintech fund in terms of particular verticals within that. We're thematically led, which means that the intent is to be able to do a deep dive on a vertical and on a particular area, map it out, identify the companies within that vertical that we want to invest in. We will, of course, be opportunistic, being realistic. We're not always going to find companies that way. But I think that the premise here is that we don't want to be ambulance chasing as much as possible. We don't want to be just going after whatever the hot deal is at a particular point in time and trying to get up to speed in a week on a vertical we don't know. So it's really about building up this repertoire of areas that we have experience in and that we have understand well. And in terms of focus, so the 70% at a minimum in Europe and 30% rest of the world. Realistically, first fund, we're probably going to be, higher than that in terms of our European exposure. But we also have two venture partners who are both from the US or US based, and so there'll be a certain amount of deal flow we'll get from there. And then also Joe and I are both Australian, so we've got a certain amount of deal flow from that as well. So yeah.
It's always the network topic. It resonates a lot with the kind of people that you are still working on or talking with, and the deal flow will come from that way. So it's kind of normal. But let's focus a little bit on the fintech side. So this is obviously one of your main other expertise, if not the main focus of the fund. And I wanted to ask you, how do you see the market in this present moment in time, of course, so the status of the fintech market, but most importantly, how do you see the market going on from now on? Because this is one of the conversations that I have more frequently. We're coming from, I would say, 2 or 3 of the worst years in this market since 2000 probably. And there's a lot of people that are still scared about investing in this market. But I think that at least from a personal perspective, we are probably at the bottom of that kind of trend, and we will probably rise up mostly in 2025 and 2026. So I would like to understand your point of view on the market right now.
I'll throw it to Joe, but we're definitely excited by the fact that less people are looking at that area. So that's a positive from our perspective. Yeah.
I couldn't agree more. I think what you're describing again is a great environment to invest in. I think we could talk a lot about how fintech has evolved, and I think it's a really great or interesting space. But I think if you just take a step back, like financial services is one of, if not the biggest industry globally. Financial services is about $11 trillion every year in terms of, so it's huge. And as an investor, that's firstly amazing. Obviously, you want to invest in big markets in big spaces.
Yeah.
But at the same time, it's a huge market, but it's massively underpenetrated by users. So of that $11 trillion, about 95% is in legacy infrastructure. So we've got the maths and we've got the data to support this. But what you call modern fintech is roughly 5 or 6% of the market. So companies like Stripe, Adyen, Nubank, Coinbase, Wise, these guys, if you take all the market caps together, it's still only about 5 or 6%. So we really strongly believe, and actually, if you go back about 20 years, that 6% was zero. So essentially, we've gone from 0 to 6 in about 20 years. And our core belief is 6 is going to become a lot bigger in the future. We'll probably go to 12, go to 15, 20. It's inevitable that this huge market is going to get penetrated further and further by modern solutions. So just that core backdrop of you have this huge growth driver behind you of legacy becoming new age, I think makes fintech and the size, just the absolute scale of this market. I think most investors would find those very compelling fundamental drivers to invest behind, like long-term growth drivers. The problem, I think, is that fintech is and can be a complex space to understand. And so I think in the period of 2020, 21, 22 even, I think you had a lot of generalist people, generalist venture capitalists go into fintech without a real good understanding of what it actually is. And then markets changed and interest rates went from 0 to 5%. And all of a sudden, these business models became pressured in ways that you didn't, if you didn't know the market, you wouldn't have known that that's a pressure testing moment. Like the revenue streams changed, the sources of funding changed, the cost of debt and lending became more expensive. The margin profiles, the unit economics of all of these businesses changed materially in this period. And you've got all of these generalist investors who just had no idea what was going on. All of a sudden, they invested in companies with not great fundamentals. They lost money, they got burnt, and they've pulled out of the market. And I think coming back to what we said right at the beginning, that's the opportunity for us. Is fundamentally fintech is a huge market. It's going to innovate. It's going to get bigger. It's proven to generate huge businesses at scale, and you've got less competition right now. So all of these things make us very excited.
I strongly agree with a couple of the points that you made. I was recently talking with Raghu, that is one of the partners of 2100 VC, that is one of your competitors in this space, actually. And he made a very good point about it. So all the business models that were basically based on 0% interest rate, they actually disappeared after 2020. Because that was not the case anymore. You couldn't actually think that a business model based on a temporary situation could last for 10 years. So that was actually absolutely madness, I would say. But apart from that, I totally agree with the point that you made about the market. So fintech overall, it's a little bit older. Let's say I would say probably been born between end of 90, beginning of 2000. But I think that the real shifting moment was actually between 2010 and 2015, where many of the kind of fintech giants that we saw right now have been born, during time. But still, if you take all of them in consideration, we are very, very early stage anyway. All of the kind of old legacy infrastructure, all the kind of traditional banks, they will need to update in a way or another. And I strongly believe that we still need to see the kind of growth that this market needs in order to be actually relevant in the future. And I would say there's no question about if it will happen or not. It's just a matter of time. It will take probably 10 years, 20 years. We don't know, but it will happen. That's kind of certainty, let's say. And yeah, this is going to be very interesting to see what is going to happen. I was recently also talking about my, let's say, prediction on the market going on in the short term. So one of my main prediction was actually about the use of stablecoin in payments in 2025. And I would like to understand what's your best take, let's say, in the year that is coming, so in 2025, but on the short term, what are the kind of trends that you are looking for, the kind of most interesting technologies that you guys are looking to?
It's a good question. I think we could talk a lot about these different things that are coming through. I think stablecoins is actually a really interesting space. Just seeing the adoption. I think there's so many use cases there that make a lot of sense, and that are, it's a matter of time. Again, coming back to what you said, like what are things that are inevitable? And for us, we feel like stablecoin adoption and use of the crypto rails in some form of payments is a matter of time. I think for us, when we look at fintech, what we really get excited by is just very much what we talked about. Legacy infrastructure getting adopted into new rails. Whether it's new forms of payments, whether it's new forms of back office automation, ways that companies integrate data into their frameworks, whether it's modern accounting systems, modern FP&A planning systems, the whole CFO suite getting completely revamped, which is a trend we've seen over the last couple of years, and we've invested into some companies there. I think it's really the whole aspects, like all the sub verticals of financial services are going through moments of flux. I think there are some areas which have already innovated. So like if you look at what happened a couple of years ago, the whole neobank space that came up and exploded, and that's probably that innovative cycle has already happened. We've got the whole thing around like expense management, banking as a service, those sorts of things have seen innovation kind of taken off. But I think there's still a huge amount of legacy infrastructure that is just inevitable that it's going to get rewritten and revamped, I guess.
I think the exciting thing about all the themes and drivers that Joe's talking about as well is that these aren't just esoteric ideas. We've been seeing companies in the last 3 months which are focusing on all these areas and have a real right to win in them. So again, with timing and where we're at, where all the more reason that we want to get going and start investing, because we think it's a really good time.
No, that
we think of. I was going to say, Michele, like one other area that we're quite bullish on is actually Europe versus the US, which is something that it's very much a topic du jour. I think everybody talks about, especially in venture. Everybody thinks the US market is where everybody should allocate their funds to. But I think in fintech, Europe has a very strong case actually for developing local grown champions. So, if you just look at the likes of
kind of areas, in my opinion, are even stronger than the US. Like, for example, take a look at digital banking and neobanking. They still lack a regional champion there.
Exactly. You've got Chime, in some form, but if you look at Europe, we've got Revenue, we've got Monster, we've got, these other fantastic businesses.
I always get the point about Chime. It's a very good company. They're going to file for the IPO this year, so it's a huge company. But if you take a look at the numbers, they're not even in the same range of Revolut or Nubank. So they're way smaller. They're growing, of course, but not in the same way, not in the same pace and everything else. So I think that, for example, in Europe, maybe this is the only space where regulation actually helped us a lot, because it established a lot of the rules that a digital bank or a neobank should follow in order to grow. So you actually follow all the rules and you can actually grow without any big problem. And that was a very, very good advantage, for example, for Revolut and 26 and all the others.
They have a lot of practice going into new markets around Europe, so they can do it everywhere else as well.
If you can do that in Europe, you can actually do that everywhere, basically. And I think that the US had a little bit of that problem, and one of the main, let's say, point of discussion when talking about US and EU, mostly when talking about venture, is the kind of different mentality that investors have in the EU compared to the US. So we're always talking about the kind of risk that US investors take compared to EU and everything else. So do you actually see that as a problem, or more as a, let's say, an opportunity also in Europe or otherwise?
Yeah. It's funny you mentioned that, because I kind of agree a little bit in the different mentalities. I think, the US investors tend to be more risk taking. They move faster. They have a faster time to build conviction and make investments. And it's actually something that we are trying to do with Defiant, is actually bring this kind of like higher energy, higher impact style of investing. I think there are, when you look at Europe, I don't want to throw shade on Europe as a continent and all of the VCs here, but I do think there is a certain type of European investor who just doesn't have the intensity of the US investing mentality. And that typically it's speed, it's execution, it's conviction building, it's risk tolerance. And that's why these US investors can come across and win deals. I think, there's a lot of, maybe sleepy European investors who probably aren't on their game or aren't on the ball. And so we really much want to embody that. We want to be front-footed. We want to be, build our own conviction in spaces before other people. We want to take sometimes even contrarian investments, and find things that if we develop our own internal conviction, we're happy to do it irrespective of what the market thinks. And I think a lot of people in Europe tend to be quite sheep-like in their investment strategy. They follow what everybody else does. And so I think there is some truth in it, for better or for worse.
No, I think that recently Jeff Bezos actually summarized that very, very well. He said that the US have by far the best risk capital market in the world, because you can actually go out there and raise a 50 million pre-seed round for something that could actually not work ever in the market, and actually have the possibility to try that. And that is not the case at the moment in Europe. We made very big progress under that point of view, in my opinion, in the last 5 years, let's say, but we are still not in the same league. I think that the US is a separate market from everything else in the world at the moment under that specific point of view, and that gave them an advantage over time. That is for sure. But it's not the only, let's say, it's not the only variable, in my opinion. Like, for example, I think that in Europe, we have a huge and very, very big and, let's say, structured university and at least academic background. We have a lot of, for example, universities all over Europe that have very good research centers that have a huge advantage over, innovation and everything else. We are not just that good on finding them, but we have the talent, we have the knowledge, we have the skills. We are missing that, small bridge to gap the knowledge with the market, let's say, or at least with the capital market.
You said something interesting there, Michele, which I actually really agree with, is the risk attitude. And actually, I think a lot of it stems from the sources of capital as well in Europe versus the US. So like we go through, we're fundraising, so we talk to our LPs, we talk to a wide spectrum of people, whether it's, endowments, institutions, and you'd be surprised, like even just seeing the pockets of capital US versus Europe. I joke, one of the, if you took a traditional European family office or, institutional LP, the number one rule they have is don't lose money. Like that's what they say. They're like, don't lose money. But if you go to the US, the number one rule is go make it. Like it's like, we're going to give you money to invest in companies. Let's try and make 10x on that. Whereas in Europe, they're like, let's try and conserve the downside. So it's very much like, and I think that then stems into or gets embodied by the VCs and the mentality, because they're taking money from other investors. And so it's like, it's just this, like, I think we need this shift of focus, and we need to find people who are willing to take bets on upside, who believe in big outcomes, who are not as conservative with their capital allocation decisions.
I strongly agree on this one. And also, if you take a look at the numbers themselves, we have a lot of wealth in this country overall in Europe. A lot of people have a lot of families with huge amount of capital. They're just not comfortable
parking it in more traditional businesses typically, and allocating less for sure.
Yeah, that's one of the let's say the problem that we have under that point of view. We are not good at investing those kind of things. We're not good at proposing alternative solution, but it's also one of the things that we will need anyway to change over time. Because I was recently reading a paper from Bain Capital. The kind of assets that we saw in the last 20 years are not going to be as profitable or as useful or efficient in the upcoming 20 years. So, for example, the stock market is not going to be on the same level, bond and everything else. So everyone is taking a look at alternative assets, and venture capital is one of the most, let's say, promising one. And a lot of family office will make that shift, at least that mental shift over time. And I think that we will see a huge inflow of capital in this market in the upcoming future, and certain kind of funds will be in the right spot, in the right place to actually benefit from it. But we are just still not in the same in the specific moment in time to actually make benefit out of it. We still need to wait that kind of inflow. We still need to wait for the right time and the right mentality to actually have that benefit.
I think it's just hopefully it's a matter of time. I think it's hopefully there's some people on this who listen to this podcast who will take that away and say, we need to allocate more to venture.
Yeah, we need to start a new thing. Yeah. We'll just probably launch at least a couple of new competitors for you guys. So yeah. But overall, let me come back to the fintech market again. So we said we are in the very, very early stage. We said there are a lot of competition, but we are still, not seeing the market to be tackled down at least, or at least innovate as we would like to be in the upcoming 10 to 20 years. So my question for you is, what are you looking for in a founder that is actually launching a new idea? So what are the main kind of variables or characteristics that you're looking for in a founder that is trying to innovate in this specific space?
We've spoken to quite a few actually in the last maybe 2 weeks, and I think that some common themes just in that small sample size is they're going for a very ambitious market. So often you're having to try and knock over incumbents who have been there for 30 years, are very large, and have very deep roots into the financial system. So you obviously, it's a cliche, but you have to be a little bit crazy or naive or some combination of it to even begin to consider going after markets like that. And the second thing is that given the complexity that we've just talked about, all of the deep institutional nature of it and that nature of it, it's they have to be from the industry a lot of the time, or they have to at least have a right to have deep knowledge or connections to deep knowledge into it, because I think we've seen a few times that hasn't been there. The ambition's been there without necessarily the right to win, and they've gotten lost along the way or haven't focused on the right areas as a result of that.
Yeah.
So the kind of network, let's say, the network, or at least the background.
Yes.
Yeah.
Yep. Yeah.
I think a lot of the time in fintech, it's like, you're a founder who's witnessed or experienced firsthand the problem in the industry and been close to that problem, and then innovated and found a solution to that problem. That tends to be a founder we really like the profile of, because they deeply understand their space. They typically have the connections to address the problem. They have the partnerships, they have exactly as Cam said, it's a very big industry dominated typically by big incumbents, and it's a very much a relationship driven industry. There's regulatory red tape a lot of the time. There's access to capital that becomes challenging. So I think finding a founder who's like addressing a very specific problem that they have felt themselves and they've worked on, that tends to be something that we look very favorably on.
Okay, now that's very interesting. A lot of time when I ask these kind of questions, one of the most frequent answer is, I want people that are obsessed with success. So let's say the doubt that I have, or at least the kind of contradiction that I see here is, do you actually prefer someone that is obsessed about the idea of succeeding, or someone that is so deep inside that kind of environment that is easier for him to succeed?
I think you always need to be obsessed. Like, I think it's a very easy thing to say as a VC. "Oh, I have to be," like I think most founders are going to be obsessed with their business, right? Like they put all of their
Yeah.
personal capital into it, and they're just like, working hard. I think we just want to see people who, work hard, hustle, run through walls. It's what we do. Like we're founders too. We've started our own VC funds. We work like around the clock every day. We have super high energy. We're obsessed with performance as a culture. It's all the things that I think you would expect in a good quality founder. I think they would embody that most of the time anyway. So we don't go, are you obsessed with your business model? Like you just want to see those.
You give it for granted that they are themselves with
I
the
think so.
capability.
I think sometimes you hear bits in conversations around like exit plans and things like that where you do maybe question longevity or like how long are you in this for? But in general, that's not the case, and you know that they're serious and they're trying to build a generational business, and yeah.
No, that's a good point. Yeah, no, something very interesting. So you actually, you actually are looking for people that are coming from that kind of environment and have the kind of advantage of being inside that kind of industry. So I think that this will resonate a lot, to be honest, with the kind of distribution problem that we see with first-time founders. There are a lot of first-time founders. They focus a lot on the product. They have a lot of experience, maybe. And they focus maybe too much on the product. They leave a little bit beyond the distribution side. With second-time founders, something that I found out is that they focus a lot on distribution. So they want the product to be present. They don't want the product to be perfect, but at least they want the product to be present, I would say, everywhere. And that is one of the main, let's say, advantage that is seen coming from that kind of environment on that kind of network,
I think more and more founders and companies are almost working out their go-to-market first. They're working out distribution very, very early, deeply embedded in their product strategy, deeply embedded in their product as well. And, as you just said, it makes a lot of sense. Selling is incredibly difficult, and especially in these kind of markets that are so old and have so much legacy in them.
I agree. I think that, the companies that I've seen and worked with that haven't succeeded, the reason, or I'd say 90% of the failure is distribution. Like, I totally agree, Michaela. Like, I think there used to be a case, like maybe 10 years ago that the best products would win. But I do think these days it's the best distribution that wins, actually. Like, if you build a product that gets you 90% of the way there, but you distribute it exceptionally well through a network, through partners, through it. Like, I think those are the companies actually win in today's world. It's so hard to get go-to-market rights, especially as an early stage business, and especially if you're selling into, as often the case in fintech, big enterprises, big organizations, even mid-market, these large sales processes. If you don't have some edge in distribution, you can really stall as a business. Your growth it's very, very hard to get that, 0 to 1, 1 to 10. Like that's just a very tight, difficult process these days.
Yeah, I would say that maybe in B2C, the best product can still win most of the time, but in B2B, distribution is everything. I mean, without distribution in B2B, you're going to fail, even with the best product, in my opinion. Yeah, I totally agree with that one. Maybe last question from my side. I was recently reading an interview from Salesforce CIO, and he was talking about the fact that this year they will not going to hire any new engineer because of the kind of implementation that they made with AI, and that is disrupting actually their hiring expectation. So this is a question that I usually ask very frequently. How do you see the kind of impact that AI is bringing to your market, and more specifically into the VC industry? We have been seeing recently a couple of hedge funds being launched based totally on AI, and I wanted to understand, do you see a venture capital based on AI coming in the upcoming future? And how do you see the impact of that kind of technology in your industry?
I might start and then you can continue. So look, it's definitely funds are popping up with AI first strategy. We know a few of them out there. I think that you always have to separate the back test of a trade versus the forward test, and particularly given access is so important in VC, right? So I can backtest a trade and identify all these companies that it would be great to invest in, but we probably could have told you that was the case a lot of the times based on the co-investors that are in a round, right? So I guess you have to separate the model and the prediction from the actual ability of the fund to invest in it. So I think that there's undoubtedly AI is going to help picking investments. It's definitely able to do many things that we're not able to do. But I would just question the ability for those predicted returns to materialize, given how much of a network game this is, given access is so important. But yeah, I mean, we're right in there. We're building tools to help us analyze companies, diligence investments, and there's a lot of AI in there on many different layers. So we believe in it. We just don't think an AI fund, as in AI first fund, is the answer.
I tend to agree to this one. Also because I think that one of the main missing point is actually the data. So you have a lot of data, of course, in your side. You can actually take a lot of data out there, but I don't think there is enough data, to actually make that kind of reasoning, because actual LLM model required a huge amount of data, and there's no single source of truth out there on all the startups that you can actually potentially invest on. So there's still a lot of data, in my opinion, that rely on word of mouth, network knowledge, and knowing the right person in order to invest. So I think that this will be anyway a network system anyway, at least for a certain part of the industry, even for the upcoming future. We will probably see a lot of data analysis being done through AI. I think that recently Revolut founder Nick Starosky launched a VC fund based on data analysis, but still there will be need of people with feet on the ground actually talking to other people. That's something that will always be necessary, I think.
Exactly. I mean, part of the reason it works in public markets is because the data in public markets is so much better. So
guys, thank you very much for joining it. This was a very, very interesting conversation, and I wish you all the best with your upcoming deals. We'll take a very good look at what you're being doing in the upcoming future. Thank you very much for joining again.
Appreciate it. Thank you.
Thank you, Mika.
Thank you.
Pleasure.
Bye bye.
Bye bye.